Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 2. This is Section G3. This is an application topic. Perform procedures to identify related party relationships and transactions, including consideration of significant unusual transactions and transactions with executive officers. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's free, it's 1 hour, and we will teach you the key ingredients to passing the CPA exam in that 1 hour. So you don't want to miss that. Make sure you go check it out. After you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. SuperfastCPA Pro members get access to the full 10-question versions of these videos. So in today's video, we're only going to be going over 5 questions on YouTube, but SuperfastCPA Pro members will get access to the full 10-question version of the video in the member forum. So again, if you like this and you like our other videos, check out becoming a SuperfastCPA Pro member so you can get access to a lot of great stuff, including the full videos. Now with that, let's go ahead and dive into the questions. All right, here we are at the first question, so let's dive in. Why must an auditor pay close attention to related party transactions during an audit? Okay, let's walk through the options. Option A, related party transactions often involve significant amounts and are always material to the financial statements. Option B, related party transactions are typically disclosed in the financial statements, so auditors do not need to perform additional procedures. Option C, related party transactions may not be conducted at arm's length, which can affect the fair presentation of financial statements. Or option D, related party transactions are only a concern if they result in fraudulent financial reporting. All right, so with that, we're kind of diving into related party transactions. If you have an idea of what those are, maybe based on a prior exam or just, working in accounting in general, then you might have a decent idea of what the correct answer is. But if you don't really know, that's okay. We are using these questions to learn what we're supposed to know about related party transactions for auditing. So let's go ahead and dive into the answer so that we can start learning about this. All right, here we are. The answer is C. Related party transactions may not be conducted at arm's length, which can affect the fair presentation of financial statements. Okay, so let's learn what that even means. A related party transaction is a transaction between an entity and a person or organization with a close relationship to the entity, such as subsidiaries, key executives, or major shareholders. These transactions may not be conducted under normal market conditions, which could lead to misstatements or require additional disclosures. In contrast, an arm's length transaction, and you might have heard that phrase before, is a transaction between two independent and unrelated parties acting in their own best interest, ensuring that the terms reflect market conditions. It's basically a normal transaction. Because related party transactions might not occur at arm's length, they can impact financial transparency and fairness. Auditors must carefully evaluate these transactions to assess their effect on the financial statements and ensure proper disclosure. So essentially, a related party transaction is not a normal transaction because it is between an entity or a person or organization that has a close relationship with the entity in question. So that might cause problems because maybe they're giving them too good of a deal, or maybe it's something that they don't typically do. Those are the kind of things that would be a related party transaction, and we'll learn a lot more about that in this video. But that's kind of the general idea of what a related party transaction is. Now let's go to the next question to start learning more. All right, here we are at question 2. When identifying and assessing related party transactions, what is one of the first procedures an auditor should perform? So let's go through the options. Option A, analyze all significant transactions and assume they involve related parties unless proven otherwise. Option B, request a list of related parties from management and those charged with governance. Option C, immediately test the financial impact of all transactions with executives and major shareholders. Or option D, review the general ledger for unusual transactions before determining whether related parties exist. Okay, so which one of these is the first thing that an auditor should do if they're trying to figure out what the related parties are and what the related party transactions are? So if you have an idea, pause the video. If not, that's okay. Again, we are learning what the steps are and what we're supposed to know. So let's go ahead and dive into the explanation if you don't already have an idea of what the correct answer is. All right, here we are. The answer is B, request a list of related parties from management and those charged with governance. So let's go through the explanation. The first step in identifying related party transactions is to obtain a list of related parties from management and those charged with governance. This helps the auditor understand which individuals or entities may have relationships with the company that could impact financial reporting. Once this list is obtained, the auditor performs procedures to identify related party transactions by reviewing contracts, board meeting minutes, and significant transactions. The auditor then evaluates the nature, terms, and business purpose of these transactions to determine their financial impact and ensure proper disclosure. This process helps assess whether the transactions were conducted at arm's length and whether they present any risk of material misstatement. So again, the idea here is at the very beginning, they are first getting a list of related parties for the company, for management, and then from there they can kind of start understanding, are these related parties going to impact the financial statements? What kind of transactions were happening with this related party? But again, the first step is obtaining that list from management and seeing if they will give you that assertion, give you that information of their related parties. Now with that, we learned a little bit more. Let's go to the next question. All right, here we are at question 3. Which of the following would not be an indicator of a related party transaction? So let's go through this. Option A, a company borrows funds from a lender at an interest rate significantly below the market rate. Option B, a company completes a large non-recurring transaction near year-end with an unfamiliar counterparty. Option C, a company sells inventory to a customer at standard market prices and payment terms. Option D, a company makes a loan to an executive with no scheduled repayment date. So which one of these would not be an indicator of related party transactions? Honestly, based on these, I bet you could figure out which one probably isn't the one that's going to be a related party or, wouldn't be an indicator of it. But if not, that's okay. However, I would highly recommend that you pause the video, think through this, or if you already know the answer, that's great. We're going to go ahead and look at the answer together right now. All right, here we are. The answer is C. A company sells inventory to a customer at standard market prices and payment terms. So that would not be an indicator of a related party transaction. And I think that's pretty easy to see. Now let's talk about a lot of the things that would be indicators of related party transactions. This question is very important because I'm telling you a lot of different things that you'll need to know. So let's go through this. Several indicators suggest that a transaction may involve a related party, including, first, let's talk about unusual financing arrangements, borrowing funds at below market interest rates, or engaging in loan guarantees with favorable terms may indicate a related party relationship. Non-recurring or unusual transactions near year end, let's talk about that one. Large or complex transactions occurring just before the end of the reporting period can suggest efforts to manipulate financial results, often involving related parties. Now let's talk about real estate transactions at unexpected prices. Selling property at a significantly higher or lower price than market value may indicate a related party arrangement. Now let's talk about loans with no scheduled repayment terms. Extending financing without a clear repayment schedule suggests a transaction that may not be conducted at arm's length. So if you're letting somebody have a loan that they don't have a due date for that loan, that's probably a related party transaction, or at least that could be an indicator of it. Now let's talk about compensating balance arrangements. Maintaining balances on behalf of another party or for the benefit of principal stockholders may indicate undisclosed relationships. And then finally, guarantees or obligations benefiting another entity. If a company guarantees a loan for another party without clear business justification, this may indicate a related party connection. All right, so those were some of the most common things that you might see in questions that would indicate a related party relationship or transaction. Again, unusual financing arrangements, non-recurring or unusual transactions near the end of the year, real estate transactions that are way higher or way below the normal prices, loans with no scheduled repayment terms, compensating balances that you're kind of just keeping there for people that it doesn't really disclose why you're keeping that balance for that person, or guarantees or obligations benefiting another entity. So again, all those things are common things that you'll probably see in questions that would be indicators of related parties. Now with that, let's go to the next question. All right, here we are at question 4. So let's go ahead and dive into this question. During an audit, an auditor identifies a material difference between the documentation of a related party transaction and management's explanation of the transaction. What should the auditor do next? So let's go through the options. Option A, inquire further with management, and if their explanation is reasonable, rely on their representations without additional procedures. Let's talk about option B, expand audit procedures to assess the reliability of other representations made by management. Option C, assume the discrepancy is due to a clerical error and focus on other areas of the audit. Or option D, consider whether the discrepancy indicates a broader risk of misstatement or fraud and communicate concerns to those charged with governance. All right, so out of those, what do you think would be what the auditor should do? Based on what we've learned so far, you might have an idea, but if not, that's okay. Again, we are learning through these questions. So let's go ahead and look at the explanation if you don't already know the answer. All right, here we are. The answer is B, expand audit procedures to assess the reliability of other representations made by management. So let's walk through this. A material discrepancy between related party transaction documentation and management's explanation raises concerns about the accuracy of management's assertions and potential misstatements in the financial statements. The auditor should expand procedures to evaluate whether similar misstatements exist in other areas. So that would include things potentially like reviewing additional documentation for related party transactions, assessing management's integrity and the risk of material misstatement due to fraud, testing other significant management representations for inconsistencies, and communicating with those charged with governance if the discrepancy suggests broader concerns. So you might notice that that last one we just read was option D. So that might be something that they would do. But again, that's not the only thing that the auditor should be doing. Option A is incorrect because the auditor should not solely rely on management's representations without corroborating evidence. Option C is incorrect because assuming an error without investigation could lead to overlooking a serious issue. And then I was just barely talking about option D. And again, this is why it's not fully correct. Option D is a reasonable step, but does not go far enough. the auditor must also expand procedures to gather more evidence before concluding on broader risks. So yes, they are probably going to communicate with those charged with governance, but that's not the only thing they should do. They should expand their own procedures. The auditor should expand their own procedures to see if there's anything else that is kind of fishy or kind of wrong about the company based on management not being accurate about this assertion when it comes to the related parties. So with that, that's something that the auditor would probably do in a situation like this. Now let's go to the next question. All right, here we are at question 5. An auditor is reviewing related party transactions at a company. Which of the following transactions would most likely increase the risk of material misstatement in the financial statements? So let's go through the options. Option A, the company's CEO's brother owns a business that provides office supplies to the company at standard market prices. Option B, a board member's investment firm provided a loan to the company at a competitive interest rate with standard repayment terms. Option C, the company sold a warehouse to its CFO at a price significantly below market value, with no formal agreement on payment terms. And then option D, the company's largest shareholder owns a consulting firm that was hired for a routine market research project at its normal billing rate. So I think this is one of those situations where probably you can already figure out which one of these is the most likely to increase the risk of material misstatement just based on me reading through those. But if you don't know, that's okay. Pause the video, think through this, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is C. The company sold a warehouse to its CFO at a price significantly below market value with no formal agreement on payment terms. I think that makes sense. Let's walk through the explanation to make sure. While all the transactions involve related parties, so all of these do have related parties, the one that most increases the risk of material misstatement is selling a warehouse to the CFO at a price significantly below market value with no formal payment terms. This transaction suggests a lack of arm's length negotiation and could lead to a misstatement in both revenue recognition and asset valuation in the financial statements. So this one would definitely cause the auditor to raise the risk of material misstatement based on this happening. Let's talk about the other options. Option A, and that was the one about office supplies at market prices, and option B, that was the one about a loan at a competitive interest rate, reflect transactions at standard business terms and do not necessarily indicate a heightened risk of material misstatement. So just to make sure that's clear, you can have related party transactions and related parties, and they don't have to necessarily affect the financial statements in a material way. These ones are related party transactions, but they're kind of normal business transactions. They are not something that's going to increase the risk of material misstatement. Now let's talk about option D. Consulting services at normal billing rates may involve a related party. But again, if services were provided at fair value, it would not inherently increase financial misstatement risk. So just to make sure that's clear one more time, you can have related parties, but they don't always necessarily increase the risk of material misstatement. Auditors must assess not just whether a transaction involves a related party, but whether it affects the fair presentation of the financial statements, particularly in cases where terms deviate from market norms or proper documentation is lacking. So with that, we learned a lot about related party transactions and what the auditor needs to know and do in these situations. Now, before we do anything else, let's do one more part of the SuperfastCPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up in the questions. You've seen 2 or 3 or 4 questions trying to teach you the indicators of potential third-party transactions or things like that. Again, they're the things you notice the most in the questions. And you write them out in your own words as the pillar topics, the key points of what you learned that day. And as you're doing this each day, you're building your own personal repository of the most important things you need to know for the CPA exam, and then you'll be ready for the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. Related party transactions versus arm's length transactions. Related party transactions involve entities or individuals with a close relationship to the company and may not be conducted under normal market conditions, unlike arm's length transactions, which reflect fair market terms. Now let's talk about identifying and assessing related party transactions. Auditors must obtain a list of related parties from management, review contracts and meeting minutes for undisclosed relationships, and evaluate the nature and terms of transactions to determine their financial impact. Now let's talk about indicators of related party transactions. Transactions with unusual pricing, loan guarantees, non-recurring year-end transactions, real estate sales at unexpected prices, loans with no repayment terms, and compensating balance arrangements may indicate related party involvement. Now let's talk about the risks of material misstatement in related party transactions. Not all related party transactions pose a high risk. Again, I mentioned that before. Just because it's a related party transaction does not mean that it's going to increase the risk of material misstatement. It can kind of still be a normal business transaction. But those with non-market terms, unclear agreements, or missing documentation may result in misstated financials and require expanded audit procedures. And then finally, auditors' response to related party discrepancies. If an auditor identifies discrepancies in related party documentation, they must expand procedures, reassess management's reliability, and determine if a material misstatement exists, modifying the audit opinion if necessary but not using emphasis of matter or other matter paragraphs. Now, that little bit right there is something I'm going to talk about with the pro members in the next 5 questions of the video. So just to make sure that's clear, remember in this video, we only went over 5 questions because it's the YouTube version of the video, but SuperfastCPA Pro members are going to get access to the full 10-question version of this video. So if you like this and if you want to learn more about what I just barely said about the emphasis of matter and other matter paragraphs, then if you become a SuperfastCPA Pro member, you'll get access to the full video. So make sure you check out becoming a SuperfastCPA Pro member. The easiest way to do that is by actually going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam, and that will give you a good path to learning more about SuperfastCPA and becoming a SuperfastCPA Pro member. So make sure you check that out as well. If you liked the video, make sure to like it and leave a comment. I hope this video was helpful, and I will see you in the next video.